Well, welcome. My name is Julina Ogilvie. I am partner and director of business development here at Principal Wealth Partners. And I am welcoming again today Bob Paolucci, our founder and CEO. This is our third market video. We started the year down and we continue to have some volatility in the markets. And so we thought we would address where we are in the market, what has changed, where are we with inflation that continues to dominate the media attention. What is the expectation of the Fed going forward? We started to raise rates finally after a lot of conversations about it. And then what do we see with the markets going forward? So Bob, welcome.
Thank you, Julina.
So where would you like to start?
Well, it's Friday, April 29th, the last trading day of April. It's about 1:09 p.m. And last night we had a client event where we talked about some of this stuff. It was very interesting. We did mention that the market, and this may come as a surprise to many watching this, is slightly above its lows for the year. And really the decline in the market, most of it happened between January 3rd and January 24th. We made a year-to-date low on the S&P 500, the broad market index, on February 24th. For those who are paying attention, the intraday low on the S&P 500 is a level of 4,114. There's a slide up that actually points to that spot, and you can see it right there. That's where the blue arrow is. So we are still above those lows. However, the NASDAQ created a new low yesterday, and oddly enough, it is still above that low today, even after the confusing but slightly negative report from Amazon and the positive report from Apple last night. They both reported earnings. Amazon missed because of their ownership of an electric vehicle company, and Apple beat their numbers. And not only did they beat their numbers, they mentioned that they're going to buy $90 billion more of their shares themselves. So that's a great thing for shareholders.
Absolutely.
However, good earnings, which most of the market has reported so far this year, have been punished, not rewarded. And sometimes that's what happens in a negative environment, right? The market is still under Fed control. It is still very sensitive to the language coming out of the Fed, interest rate movements, it takes positive earnings. It takes enough selling of maybe lower quality securities,
right?
And it takes a little bit of time for the pain to stop, but once it does, the pleasure begins, and we are very close to that level. We believe, with all the research that we do internally, and we talked about some of that in person at our event last night. We'll talk about a little bit of that today as well.
Yeah, and I think that's very important because that's not what a lot of people are seeing right now when they're looking at the media and listening to them. Yeah,
you're certainly not hearing anything pleasant if you're watching television, the financial news, regardless of the channel you're watching.
Right. And one of those fears, of course, is, as I mentioned earlier, is this inflation concern. These numbers have topped decades old numbers. Can you talk a little bit about what's transpired and where we think this is going to go?
Yeah, certainly. So we mentioned back in January that, of course, inflation is going to run a little hotter. We had the world shut down at the same time and reopen at the same time. While having the world in sync sounds wonderful, when the global economies are in the same cycle at the same time and consumers are consuming the same stuff at the same time, and businesses are restocking the same stuff at the same time, it creates at least a short-term inflationary environment, and that's what we think we're in.
Mhm.
Short term can be kicked around a little bit. Is that 6 months? Is that 18 months? Is it 24 months? I think it's around 24 months, right? We're in the process, the economy, the supply chains, consumers, we're still in the process of getting back to normal, right? Our lives are still getting back to normal. We're not there yet. We're getting closer. So with that, when Japan and China and Europe and the United States and Mexico and Canada, when we're all buying the same stuff at the same time, it's not that raw materials aren't available. It's everyone is consuming them, and certain materials are in different parts of the country. There are trees outside. There's wood. There's not a processed wood, maybe in Connecticut, but there is in Canada, right? So you have these spotty levels, country to country, sometimes town to town, and we're in the process of watching that normalize out over time. So, look at inflation. The Fed and our government created a massive amount of money, and that massive amount of money was sent out to individuals to, in many cases, help them. In some cases, it was waste, but in many cases, all of that sort of came into the economy very quickly, right? The money that was provided was to take the edge off of what could have been a multi-year pandemic economic slowdown. The quick reopening that parts of the world went through was really a shock to many, and it actually fueled consumption.
Right.
And again, I think the most inflationary part of this was the similar consumption of most things at the same time.
Right.
Starting to see that get back to normal. And I believe that the prediction that we made in January and doubled down on in February will come true, that before June, inflation peaks. I'm quite confident in that.
Okay.
And part of that is high prices over time for many things will quickly create lower prices
Right.
for many things. If there's a little bit of demand destruction, and you're starting to see little pockets of that.
Okay.
Know that anyone is thrilled to pay, a 55% premium for a used vehicle,
Right.
an upcharge for a generic new vehicle when they can just wait 6 months. And you can talk about other areas of the market and other goods
Right.
that as well. So we believe inflation has peaked, and we will see it dramatically fall over the next 6 months. But it's very easy to project out the negativity and the high inflation level that we have today over the next 20 years.
Sure.
That's never been the case. And you have an interesting slide up here. And what you see is the purple line. When it rises dramatically, it's followed by a dramatic fall, a very dramatic fall. Now, part of that is demand destruction. Part of that is supply chain. There's a lot that goes into this, but
Right.
whenever you see a very quick rise in inflation, it's usually followed by mean reversion.
Right.
Decline.
Exactly.
Those things very quickly.
And that's why the Federal Reserve follows the gray line instead of the purple line, because it's more volatile. And
Absolutely right.
And is it fair to say, is if we have reached that peak, right? If you look at that dotted line, which shows a 2% inflation trend going back, do you think we're going back to 2?
I don't know, Julina, we've talked about this so much. Maybe 2 is this artificial low, right?
Right.
It was still, a lot of that had to do with the housing crisis, the financial crisis of 07, 8, and 9. the economy didn't really recover
Mhm. Interest rates were non-existent.
for some time. Yeah, interest
Yeah.
rates were artificially low for a very long period of time.
Right.
Um, and you know, just 2 years ago, we had the price of oil go negative.
Right.
So those are unusual levels. So,
Sure.
you know, what's a fair level for inflation? Well, maybe the 30-year rate of inflation makes more sense. And that's somewhere between, you know, 2.25% and 3%.
Right.
So I think inflation will come down dramatically, but we'll live in a slightly higher than normal or slightly higher than we've had inflation rate for some time.
Okay. Yeah.
And what is that? Probably somewhere between, you know, 2.25% and 3%. When do
Okay.
we get there? It could be very quick.
Right.
You know, before we get to 3%, we'll probably spend a quarter or two at the 6%, 5%, 4%, and then bottom out probably somewhere
Okay.
below 3.
No, that's great. Thank you for sharing that. And it's hard not to talk about inflation without talking about the Federal Reserve, because they're the ones that started this language late last year. They talked about possibly raising rates, and then we're finally there. So can you walk through what they've done and what our expectation is?
Yeah. So it feels like the Fed has increased rates 100 times. And if you watch television, you'll hear the various investment banks um, looking for 15 increases, 12 increases, and now they're starting to backtrack,
Mhm.
right?
Yeah.
They're backtracking because the bond market moved in anticipation of the Federal Reserve actually doing something.
Right.
Which I believe is exactly what the Federal Reserve wanted,
Mhm.
which is a reaction to their language.
And Bob, sorry, when you say that the bond market moved, can you clarify that a little bit? What does that mean to investors?
Absolutely. We actually have a slide for that, Julina. Can you pull up the yield curve?
Oh, yes.
So what you'll see here is the blue line is the yield curve. So really where short-term rates, intermediate-term interest rates, and long-term rates are as of 2 days ago. The gray line below it is where interest rates were short, intermediate, and long-term as of the end of the year. So December 31st of 2021 is the gray line. April 27th, 2 days ago, of 2022 is the blue line.
So we're talking about a matter of months.
Months.
Yeah.
And rarely do you see moves like this in yields, which also tells you a movement in yields will give you a pretty significant movement in price when you look at bonds, right?
Sure.
So what you see here on that gray line is 3-month rates were at 0. Now they are about 0.75%.
Mhm.
Really, the big change was the 2-year from 0.73% to just about 2.6%. The reason why I even mentioned the 2-year is that's a good indicator of short-term rates. The repricing that you see there is really the expectation of what the Fed might do. So the Fed looking at this could say, well, just based on what we've said, the market has priced in just about 2 full percentage points of change.
Right.
Massive. So the Fed could technically do that. The market has already priced it in. So the Fed could do it if they need to. I don't think they will.
Right.
On the last call that we did, I mentioned that we were in the camp of the Fed actually increasing interest rates less than what's being said on TV.
Sure.
I believe we are still there. We believe there will be 2 more rate increases, but by 0.5% each.
Right.
2 more increases by 0.5%. That gives you a 1% move in short rates, plus the quarter that they already did. Remember, they increased once.
Right.
So that will give you a 1.25% increase. And the market has priced in, like I said, just about double of that.
And is it fair to say, Bob, when you say that the market's priced it in, that's the reason that investors are looking at their bond portfolios down for the year?
Absolutely.
It's because of this anticipation, even though they've only moved rates once, it's the anticipation that they're going to continue to do so.
Yes, and if you've been a client of ours for some time, you have heard me and others at the firm bore you with bond interest rate sensitivity and what that does to price. And this is why we're invested in these bonds versus your traditional bonds, because traditional bonds are very interest rate sensitive. And when interest rates are very low, like at zero,
Right.
the only place to go is up with interest. So if interest rates go up, bond prices go down. And that is exactly what has happened this year. Core bond funds, as an example, I'll give you the Vanguard Treasury Bond Index, which is a very big bond fund index, is down about 17% this year, more than the stock market.
Exactly.
If we look at corporate bonds and government bonds, they're down about 12% which is actually what the S&P 500 is down.
Right.
So there's been a lot already priced in. Like I said, most of it was done in January, and we'll show you a chart of that. It's hard to believe, but we will prove it to you. And we think this year is going to really be a tale of two halves. First half, you're going to hear the Fed talk about increasing interest rates, which is overnight interest rates. Second half of the year, you're going to hear the Fed talk about balance sheet reduction. That means they're going to stop buying bonds to help stimulate economy and provide liquidity. They will likely stop that very soon, or taper away from that very soon, which also means they will stop reinvesting the proceeds from the bonds that they bought. Right. So that will very likely move long rates up a little bit more. Why do I even mention that? Well, you also hear on TV something about the inverted yield curve. That's where short-term rates and long-term rates sort of intersect, right? If short-term rates are higher than long-term rates, that's an inverted curve. That is not good for banks. And I'll explain that. Bank of America doesn't want to pay you 3% for your deposit to lend it out at 2%.
Exactly.
They make money when there's a spread.
Right.
And they will lend money when there's a spread. If there is no spread, they will not lend money. If they don't lend money, the economy will suffer the consequence.
Exactly.
The Fed is keenly aware of this. So again, I think they are playing a little game with the market here. And I think they will be much more cautious than how Wall Street investment banks are reading their language.
Right.
Because the Fed really hasn't said anything. They really have. It's really the interpretation of Wall Street saying, well, we think rates are going to go up by, a lot quickly.
Yes, absolutely. Yeah, they continue to drive a lot of this volatility that we're seeing.
Yeah, I like to look at the action, not the words that they use. And the action is, well, they've increased rates one time so far by 1/4%. Literally, they move short-term rates from zero to just above zero.
Right.
That's where we are.
Okay.
So going on the theme of a tale of two halves, you now have a bond market that looks appealing. And if you can pull up that yield curve chart again, one thing we'll point out here is that not only are short-term rates higher, but so are intermediate term rates. So if you look at, let's just pick a number here, 7 years and 10 years.
Right.
Yields on bonds, generally speaking, have just about doubled. Right? You almost have double the yield now. And that's important because now you have an investable asset class again. Bonds here look somewhat attractive.
And that's one of the reasons as well that the mortgage rates moved as much as they did. Absolutely.
Yeah, it's mortgage rates have moved a lot. Keep in mind, banks want to try to capitalize on a higher rate narrative because it is true. But it's interesting if you shop bank to bank how wide the spread between one bank's mortgage rates are versus another.
Right.
And that's really up to the bank to price that in.
Sure.
But you're right, mortgage rates certainly have come up very quickly. I believe the second half of the year, you will see lower interest rates. Again, I say that because I think the bond market has overpriced, overplayed the Fed. And that's important because it has a direct impact on the stock market. I
Which
think
again goes back to the volatility in bonds that investors have seen this year. That may be behind us.
I believe it is behind us. I think for now, looking forward, bonds look very attractive.
Mhm.
I think you are getting a good yield, an acceptable yield.
Mhm.
And if yields decline from here, and you have bonds today, you might get the yield and price appreciation.
Right.
Uh,
And Bob, on that note, can you quickly address the municipal bond market, because we've seen a unique opportunity here as well?
Yeah, sort of the same thing happened in the municipal bond market. The municipal bond market is a little smaller than the government bond market and corporate bond market. Really, the bulk of the investors tend to be individuals who are trying to buy bonds to provide tax-free income. There's a tax savings there. And most of the buyers tend to be in a higher tax bracket. So it's not for all, it's for some.
Right.
However, in a short period of time, the municipal bond market has sold off a little bit more because it's a smaller market, it's less liquid, creating an opportunity for anyone in any tax bracket to actually make more money buying tax-free bonds. Even if you pay no tax,
Right.
your yield will be more than a government bond, and in some cases corporate bonds, depending on the corporate bond.
And
that's
it's extremely rare.
It's very rare. It's very rare. Creating a once in a not lifetime, but just a very unusual opportunity to buy tax-free bonds.
Yeah,
So
that's great. Thank you.
When you're listening and you want to hear more, let us know.
Mhm.
For our clients that need municipal bonds, we're already invested. But to put cash to work now is a very good time. And then again, just continuing on my second half discussion, we will likely see an equity market that is now significantly less expensive. The PE ratio of the S&P 500, which is a one valuation metric, which you can really judge if the market is expensive relative to history, cheap relative to history, so on and so forth.
Right.
That level went from year end on the S&P 500 about a level of 22, which was a little above its long-term average,
Right.
to below its 10-year average. So the market is cheap. And why did that happen so quickly? Well, there are actually two reasons. Stock prices, right, have come down, and earnings have gone up, which is also very unusual.
Absolutely.
Earnings, the direction of earnings, and the price of the S&P 500, they are typically highly correlated.
Yes.
Certainly, if you look year over year, they are perfectly correlated. But if you look in shorter term periods, like a month, a quarter, quarter over quarter, month over month, emotion gets in the way.
Yeah.
And
a lot of ups and downs.
That creates opportunity. So ultimately, we invest in companies because they provide earnings or earnings growth, or an opportunity to have earnings in the future. Earnings are quite good in aggregate, and that direction continues to point higher. So really, whether it's the bond market or the stock market, there is an opportunity here to pick up quality investments at a level that we haven't seen in, at least for the stock market, a year, and for the bond market, 4 or 5 years.
Right.
Really, maybe 2018, 2017. So really a good opportunity. Those opportunities don't last long, right? Think about a sale at Nordstrom on high-end mass purchase shoes, right? The sale doesn't last long, especially in your size. So what you'll see pretty quickly, and I say this, I don't want to come off too casual here. The amount of research that we do is, I would say, would be shocking to people listening to this. There are hundreds of indicators that we look at.
Mhm.
When you have a majority of those indicators pointing to either a bottom or close to a bottom, that is when we have the level of conviction that we have to say these things.
Right.
The last one that was triggered was just a couple of days ago, actually on the 27th, the volatility index went into a position where short-term hedging is much more expensive than long-term hedging.
Mhm.
And every single time that has happened over the past 20 years, you have had a rally in the market. And that just happened
Absolutely.
2 days ago. So that was, for us, that was the one thing that we were waiting for,
Mhm.
to really have the highest level of conviction going forward, and that happened. So now keep in mind, black swan events can happen.
Of course.
Situation in Ukraine with what Russia is doing there is horrendous. And if it gets worse, or if there's a chemical attack, or God forbid, a nuclear attack, that obviously
Mhm.
really changes psyche for investors.
Right.
But I would say, barring a black swan event, I would say new investors are going to be very happy 6 months from now, 3 months from now, a year from now, 2 years from now.
Right. And I think it's interesting because when I look at the media and the concern that they're, the anxiety that they're giving our investors out there, it really is just a couple things. It's on the notion that inflation is here to stay above 8%. And it's that yield curve you were describing is going to invert, and that's going to drive us into a recession. And I think what you're trying to explain, and we don't have enough time on this call today to do it, is that we are looking at a number of other factors, right? Whether it's economic growth, earnings, buybacks, money in cash, or excuse me, consumers that have cash. It's tremendous, the opportunity that we still continue to see. Is that fair to say?
That's correct. I mean, we could talk for, as we do internally, we can talk for, 6 or 7 consecutive hours about this stuff. And I would love to, but no one will listen. So we try to summarize for our clients, for those who are listening to this, in less than 45 minutes, our thinking. But we try to deliver the backup to our thinking, because turbulent times, you need to see the facts, you need to hear the granular data, whether you like it or not. And we're happy to provide it. So
absolutely,
the Fed is keenly aware of what a recession is and how they are created. They can create them. They oftentimes do. I don't believe the Fed wants to create a recession here. I also believe that what they were saying last year is true. Inflation is transitory. I think there was a problem defining transitory. I think if they put more of a concrete time frame on it, like 24 months, 18 months, we would still be talking about transitory. But we're not. Now we're talking about nimble. And I also read nimble as we may go up and down.
Right.
Rates. So that's not. I believe the Fed is also looking at employment, saying, well, this country, we have 2 help wanted ads for every 1 unemployed individual. A level that is unheard of. So the job market is very strong. And I believe the Fed is viewing it as, if we weaken the job market for a few quarters, that's okay. We will make the unemployment level fall back to 2019, which was also the lowest level of unemployment we've seen in 50 or 60 years.
Right.
So I think they're willing to be guilty of, creating some job losses.
Okay. No, that's great. Thank you for that.
I don't think they're willing to put us into recession, but they know where they can push. And as they say, don't fight the Fed, trust them. even when we are listening to people on TV say bad things about them, they have all the data.
Absolutely. Absolutely. And thank you for going through that. And I think the one other thing I would comment on to maybe go off of your Nordstrom analogy earlier is not only do we see a lot of optimism in the market, but your reference of shoes being for sale, I might actually suggest that 90% of Nordstrom is for sale right now with both the stock market, the bond market, the international. There's very little that is positive this year.
Correct. Yeah. All asset classes are down.
Yeah.
Cryptocurrency is down for those wondering. Foreign investments are down. Foreign bonds are down. US bonds are down. US stocks are down. Large cap stocks are down. Small cap stocks are down. Really everything is down. But again, it's the period of time in which we're talking. If we go back over the past 12 months, 18 months, just
Right.
about positive.
Absolutely.
Right. So this is what happens in short periods of time. It doesn't stick around for long. It does create opportunities, and it doesn't stick around for long because it creates opportunity for entry.
It's another example that we continue to say that short-term volatility tends to be based more on emotion,
Yes.
and that the long-term tends to be more focused on the fundamentals.
Yeah. And Julina, you always talk about these type of intra-year declines being normal. And we have a slide that we typically use for that. Can you pull that up?
Absolutely.
And do you mind just explaining what we're looking at here?
Yeah, sure. This is a slide that goes back to 1980. It shows you the calendar year performance starting in 1980 on the left in the blue bars and all the way to the right where we are today. You'll notice that the blue bars, meaning the calendar year performance of the S&P any given year, tends to be positive, right? The bars are positive versus negative at least 75% of the time. But then you also have these black, which are showing you the worst point of the S&P each and every year. And it's the one thing I always joke I can guarantee in the markets is that you will lose money at some point in the year in the market, right? And you can't time those little diamonds because they tend to be based more on emotion than they are fundamentals, right? What I also think is intriguing about this slide is you have that yellow line running across the bottom, which is the average decline intra-year. And I think it's interesting that despite the emotions that we're having as we look at our portfolio returns and how much money we might have lost this year, it's actually eerily normal right now.
Yeah, it just goes to show you that the market goes down and it is down temporarily. So just looking at this, it's amazing that the way the market finishes for the year is the top of each blue bar every year. And during the year, it was almost always, let me see. Yeah, it was always negative, right? You never had a market that just charged higher all the time. It was always a wide range.
Mm-hmm.
And what's also interesting is you never had a market close at a low.
Right. And I've said this before, but it's one of the first things I learned when I got into this business is that those black diamonds are indicative that the market is not an escalator. It is a yo-yo on an escalator.
Mm-hmm.
Right.
Absolutely. Yeah.
So.
Yeah. And look, thinking like a client as well, we're invested in this market. Volatility is the price you pay for good returns over time.
Right.
You have to have this level of volatility to create value. Shares of your favorite company have to come down a little bit to attract new investors, and it does. Right. Always. There are tons of other positive things that we can show, like how dividends grow always over time, how much money is waiting to be bought back by all companies. Mm-hmm. Of their shares are about to be bought back, which is going to be massive, right. More than ever in history. How pensions are investing a record amount of money in credit.
Right.
Bonds of publicly traded companies, and that's where a lot of the buyback money comes from.
Mm-hmm.
These are all positive things, not negative. Again, just zoom out. This is a short period of time.
Absolutely. Yeah. Thank you for going through all that. And I hope that everyone listening is getting an idea of the confidence that we have. And I will also share with, all of our clients or anyone listening that we will continue to update as we see the markets shift moving forward. We're here to answer any questions. Please, reach out to any of us at Principal Wealth Partners.
Great.
And thanks,
As
Bob.
always, yeah, you're welcome. And as always, we appreciate the business of our clients, their friends and family. And we're here to help you live a better life. So if anything is keeping you up, you're concerned, feel free to reach out to any of us, your advisor, me, Julina, anyone, feel free.
Thank you, Bob. Thanks, everyone.